is Money Talks. I'm Greg Vogel, Portfolio Manager at GKV Capital Management. 2025 started strong. Inflation was down, interest rates were starting to fall, and unemployment hovered just above 4%, which is historically low. And Americans had more disposable income than ever, over $65,000 on average. All signs pointed to a booming economy. Confidence was high, and investors were optimistic. Stocks were riding that wave too, with the S&P 500 trading at nearly 30% above its long-term average valuation. Investors, many from other countries, were paying a premium just to be part of the American growth story. But all that optimism hit a wall in early April. On April 2nd, the U.S. announced sweeping new tariffs, basically a tax, on imports coming from all of its trading partners. As announced, it was the biggest tax hike since the 1980s, totaling over $250 billion. And just like that, we're in a trade war. There's an irrationality to trade wars. After all, it is widely accepted that tariffs significantly deepened and prolonged the Great Depression. We assumed, along with Wall Street, that this was a negotiating tactic, a way for the White House to force better trade deals, but that theory started falling apart fast. This wasn't about a short-term deal. The goal here, reshoring American manufacturing, bringing factories and jobs back to the U.S., no matter the cost. The strategy is clear: limit cheap foreign goods, cut immigration, and rebuild U.S. industry. That may sound patriotic, but there's a big catch. This shift is disruptive and expensive. Businesses now face higher costs, and consumers will too. The risk? Slower growth, higher inflation, and even recession. We started the year expecting double-digit earnings growth in 2025. Now, that's unlikely. The S&P 500 dropped 19% from the high, and the US dollar is weakening rapidly as foreign investors pull money out. Let's talk about tariffs. There's a common misconception that the country being taxed pays the price. That's not true. Tariffs are paid by importers, often US companies, which pass those costs on to consumers. For example, a Wall Street Journal breakdown found tariffs could raise the price of a new iPhone by nearly $300, more than 50%. If Apple absorbs those costs, its profits will get cut significantly. If it passes the cost on to you, well, you're now paying luxury prices for a new phone. And it's not just tech. US automakers rely heavily on cheaper labor and parts from Canada, Mexico, and China. Building more cars in the US means higher costs. $70 per hour for labor here versus $7 per hour in Mexico. Even Tesla isn't immune, facing $4,000 in extra costs per vehicle due to imported parts. Modern corporations are carefully managed, and any expense will quickly eat into profits. You can see the two recessions in the last 20 years, 2008 and briefly in 2020, where profits declined sharply. When corporate profits fall, stock markets decline and unemployment spikes. We have started an economic trade war, and not just against our enemies, but against the entire world, all at once. As the trade war plays out, uncertainty has skyrocketed, and markets hate uncertainty. Stock prices are built on expectations of future earnings. When those expectations get blurry, valuations fall. That's exactly what we're seeing now. This is a chart of the Global Economic Uncertainty Index. We are as high today as the beginning of the pandemic. The pandemic wasn't something we could control, but this trade war is self-inflicted. Our best guess is that corporate earnings may be flat with last year, but that depends on how the trade war continues to develop. With each passing day, the Trump administration changes the policy to include or exclude various imports. Yesterday, it was announced that electronics, iPhones, would be excluded from the massive tariffs on China. In turn, China announced it will restrict export of critical rare earth materials that are critical for a wide range of products, including EVs and defense contractors. China controls 90% of the world's rare earth production. The math behind stock valuations is not complicated. Investors need to feel confident they'll get paid. If risk rises, prices drop until the potential reward justifies the gamble. Investors are backing away from high-flying tech and consumer stocks. They're shifting into more defensive plays like healthcare, utilities, and even gold. We're increasing cash and buying more bonds. When chaos hits, safety matters. Look, this doesn't mean the American economy is doomed. It's still very resilient, but the ever-changing tariffs add tremendous friction to business, and they make it difficult to plan. Over 80 years of global trade driving lower prices and higher profits, we're now hitting the brakes, and that changes everything from how companies operate to what you pay at the store. Free trade gave American businesses cheap parts, cheap labor, and global customers. Without it, companies will have to rethink their entire strategy, and that's going to take time. So what now? Well, it's not time to panic, but it's time to be cautious. Markets will recover, they always do, but it might take time. Until we get more clarity on policy, on inflation, on earnings, expect more volatility ahead. For now, the smart money is being patient, because in investing, when the outlook is foggy, cash is king. For more detail on our analysis, you can download a quarterly update from our website at gkvcapital.com. You can also sign up for our email distribution list to receive our reports directly in your inbox. Thank you very much for watching.